They were the richest bankers in Europe. They counted kings as clients and popes as customers. And then, in a single decade, they were nearly bankrupt. How did a house that once held the keys to papal coffers unravel so fast? Why did they turn from ledgers to liturgy, from counting houses to chapels and crowns? The answer lies in bad loans, artistic obsession, and a deliberate, almost surgical shift. When commerce failed, power became the hedge. Listen, in the late 14th century, a merchant family in Florence began to think like a state. Giovanni di Medici opened a bank that would grow into an invisible infrastructure of European finance. Its agents in Rome, Bruges, Geneva, Venice, moved bills of exchange, letters of credit, and bullion across borders. The Medici learned how to make money from mobility, enabling merchants and monarchs to move wealth without moving chests of coin. They learned how to make trust portable. Trust, more than coin, became their product. Their name was written across the contracts of princes. Their vaults held the transfers for churches and the mechanisms for war payments. To go to the Medici was to access a pan-European clearinghouse. For a century, the Medici were the plumbing of late medieval Europe, invisible, essential, and nearly everywhere. Then they became more than bankers. They became patrons. They became cultural sovereigns. Cosimo the Elder understood the arithmetic of influence. He knew that a marble altar and a new facade could turn public esteem into political capital. He spent not only to beautify Florence, but to bind talent and loyalty to the Medici name. That approach matured under Lorenzo, his grandson, a man remembered now as Lorenzo the Magnificent. He spent like a prince and loved the city as a courtier loves a queen. He gathered poets, philosophers, and painters under his aegis. He financed libraries, festivals, and the most dazzling commissions of the age. The Medici household became a stage, and art was a currency of reputation. But reputations are not the same as liquidity. Bankers must answer to creditors. Art does not pay interest. The bank's structure hid both its genius and its fragility. Each branch operated like a partnership, with local managers making lending decisions and accounting back to Florence. That decentralized model allowed rapid expansion. It also allowed risk to accumulate out of sight. Agents trusted royal promises. Monarchs promised repayment in lands, tithes, or future taxes, promises that looked plausible in the glow of power, but were fragile when wars or dynastic misfortunes intervened. The heavy clients were not merchants. They were kings and princes. Lending to royalty carried prestige, political leverage, and the hope of contracts. It also carried a systemic risk. Sovereign obligations are not like mercantile bills. Kings defaulted through bankruptcy, territorial loss, or simple political will. Over generations, the Medici extended large credits to courts across Europe. When a cascade of defaults hit, when one king could not pay and another expected leniency, the exposures multiplied. By the close of the 15th century, bad debts had become a structural wound. There were specific human failures too. A trusted manager in Bruges made risky loans to cloth merchants and to local elites, and misreported the exposure. The Rome office blurred church revenues with family expenses. Political favoritism warped discipline. And above all, Lorenzo's household consumed capital. He was not an incautious spender as much as a deliberate placer of social capital. Commissioning churches and filling them with art was a way to insulate the family's reputation. But when credit lines snapped, those cultural investments could not be redeployed overnight to meet obligations. The bank, which had once been the instrument of sovereign finance, found itself overextended to sovereigns and underfunded to survive their failures. The crisis point arrives in the year everyone remembers, 1494. For years, the Medici had been stretched. For years, the household had been a center of luxury. Then foreign armies marched into Italy and Florence faced choices it had not been forced to make. Charles VIII of France invaded. The Medici scion entrusted with Florence's diplomacy, Piero, misread lines of allegiance. He yielded too much to the French and lost the city's respect. Popular anger, already fermenting, found an articulate new voice in the Dominican friar Girolamo Savonarola. The Medici were expelled. The bank that had held papal accounts and monarchical credits effectively ceased to be the economic power it once was. This is where the story turns from collapse to what I call the regulatory pivot. When the commercial machine failed, the family did not simply die with it. They translated their social capital into institutional control. Over the decades that followed, they moved deliberately into the structures that define regulation: the church and the state. First, they pursued ecclesiastical power. A Medici son, Giovanni, rose through the church hierarchy and in 1513 became Pope Leo X. The Medici family had, in effect, moved from servicing a regulator to becoming the regulator. The mechanics of that shift were not instantaneous or purely opportunistic. They were a strategic reallocation of family resources. Where once they had lent to popes, now they inhabited the papal throne. The papal office brought not only spiritual authority, but a different ledger of economic instruments: indulgences, benefices, church pensions, and the power to confer offices that carried revenue. It permitted insiders to redirect flows of value into family coffers by legitimate canonical channels. Ecclesiastical power could recouple prestige and profit, and it offered privileges beyond the reach of bankrupt banks. Second, they converted their presence in Florence into sovereignty. Over the course of the 16th century, the Medici shifted from being the city's unofficial ruling family into formal dukes and then grand dukes. Cosimo I, descendant of the banking Medici line, became Duke of Florence and later Grand Duke of Tuscany. Titles brought taxable authority. Landed rule provided steady, extractable revenues from agriculture, tariffs, and administrative fees. Where bills of exchange had once been the family's core asset, territorial sovereignty became the new revenue engine. The mechanisms of wealth generation changed from credit provision to rent extraction and fiscal administration. This transformation looks, in forensic terms, like a swap of instruments, from liquid financial capital to institutionalized, quasi-fiscal income. Why did they choose this route? Because formal power can rewrite the rules of economic survival. A bank can be ruined by default. A court can create pensions, grant monopolies, or raise taxes. If you control the office that sets the terms, you can protect your remaining assets. Becoming the regulator is the ultimate hedge. This pivot was not only strategic, it was also cultural. The Medici had always been savvy managers of reputation. They used marriage alliances, patronage networks, and ecclesiastical placements to rebuild a social system hospitable to their return. When Giovanni became Pope Leo X, he did not simply wear the tiara. He repopulated the church with relatives and secured benefices that funneled income back to the family. The Medici brand, once a mark of private creditworthiness, became the brand of a dynasty. Paintings and palazzi were no longer just displays of taste. They were instruments of statecraft, demonstrating permanence and grounding claims to rule. There is an unsettling economic logic to this shift. Think about a bank facing ruin because its debtors, kings and nobles, default. It can try to salvage the bank through restructuring and austerity. Or it can change the institutional terrain so that its defaults cease to matter in the same way. If you can create new legal privileges, if you can define taxation regimes favorable to you, if you can appoint the officials who audit your books, then your past losses can be absorbed differently. That is regulatory pivot. It is forensic economics applied to survival. When the market fails to protect you, seize the apparatus that makes the market. Yet the pivot had costs. Turning to church offices and ducal titles changed incentives. Revenue became more stable but less liquid, less fungible across borders. The art collections and palaces that once served as cultural capital became family reserves, treasuries that conferred prestige and could be pawned in extreme circumstances. but not the same as a functioning international clearinghouse. And by leaning into political power, the family entangled itself in the passions and perils of rule. Being a bank allows withdrawal. Being a ruler invites rebellion. There are human faces to these abstractions. Imagine the Medici ledgers after a courier delivers the news of yet another dishonored bill from a European court. The ink blots on the page, and a clerk, young and ill-paid, looks toward the Medici salon, where a poet debates platonic love. Lorenzo hears the news, but also sees an unfinished fresco by a promising young painter. He decides, again and again, to answer social obligations with patronage. He believes, with the intensity of a man who has read Machiavelli before Machiavelli, that cultural dominance will protect political and economic standing. But when the defaults accumulated, when the ledger's red ink deepened, the family's strategic patience had been exhausted by external shocks and internal slippages. There is an irony in how the Medici's role as God's bankers contributed to that pivot. Serving the papacy gave the bank immense advantages: enormous deposits, predictable cycles of ecclesiastical income, and the prestige that widened credit lines. But it also bound the bank to the fiscal volatility of the church. The church's own revenues depended on politics and on indulgences, and on the willingness of secular rulers to remit tithes. When the bank found its coffers exposed and Florence's political order shaken, the family recognized that the ultimate safeguard lay in possessing the very ecclesiastical office that had once been a client. The path from servicing the Pope to being Pope was not purely pious. It was an economic contingency plan. Midway through this tale, if you're enjoying this journey into money and power, consider subscribing for more deep dives into history's financial pivots. It helps us keep telling stories like this. The return to power was neither linear nor moralized. After the 1494 expulsion, the Medici lost Florence. They survived because their networks extended beyond a single city. Allies, kin, and the slowness of political shock absorption allowed them to stage a comeback. By 1512, a restored political order began to favor the family's return. By 1513, the papacy crowned them in a way they had already been crowned in practice, as custodians of both spiritual and temporal wealth. This is also a story about moral hazard. When institutions expect rescue, they take greater risks. For generations, the Medici benefited from the implicit assumption that they were too central to fail, too interwoven with European fiscal life to be allowed to collapse without causing broader damage. That assumption encouraged lending to sovereigns, whose default risk would have been unacceptable for a smaller house. The same dynamic plays out in modern finance, when entities deemed systemically important take on outsized risk because market actors anticipate bailouts. The Medici were, in their era, systemically central, and that centrality warped incentives. As the family became more a household of rulers than bankers, their priorities shifted. The calculus of risk management hardened into statecraft. Instead of extending letters of credit to merchant ventures, they regulated trade through tariffs and customs duties. Instead of diversifying across branches, they consolidated revenues from Tuscany's agricultural plain and the taxes of their subjects. Land and ecclesiastical benefices replaced bills of exchange. They had, in effect, swapped one balance sheet for another, from credit exposure to sovereign income. In the final phase of the story, the emotional stakes magnify. The Medici's pivot preserved the family, but it reshaped what survival meant. The vivid splendors of Renaissance Florence, the sculptures, the piazzas, the frescoes, became instruments of dynastic memory. They ensured not by interest-bearing bonds, but by narrative, the story of a family that brought order, beautified a city, and hosted genius. There is consolation in that, but also a cost. The banking genius that once lubricated European trade dissolved into a political dynasty that would, in time, face new reckonings, wars, Reformation tensions, and the structural shifts of early modern state formation. For us, the forensic economics of this failed dynasty offers clear lessons. First, liquidity matters. Cultural capital and reputational power are invaluable, but they cannot pay immediate debts. Second, Institutional redesign is a form of survival. When markets fail, powerful actors often seek to change the rules that define market outcomes. The Medici shifted from market participants to rule makers. Third, centrality breeds risk. Being indispensable invites outsized responsibility and, sometimes, the pathological risk-taking that comes with perceived protection. The ending is not tidy. The Medici did not vanish. They re-emerged as popes and dukes, patrons and rulers. The bank's collapse did not destroy the family, but it destroyed their identity as bankers. To secure what remained, they remade their role in Europe's political and religious structures. That remaking secured safety, at least for a time, but it also privatized failure into dynastic rule, a transformation from a finance house that could be restructured into a dynasty that had to be defended. Listen to how this plays out in the ledger of human motives. On one page, a clerk writes an amortization schedule. On the next, a cardinal signs a dispensation in ink the color of incense. One instrument measures returns, the other measures allegiance. The regulatory pivot bridged those pages. It was not a single decision, but a chain of adaptive moves, each understandable, and each with its own moral calculus. The Medici story closes by reminding us that money is never merely money. It is power, obligation, reputation, and art. When markets fail, those with resources will seek the means to re-anchor value. They will seek offices, titles, and institutions that rewrite the ledger. That pivot can conserve wealth, but it can also remap public life, changing the flows of income and the locus of authority for generations. If this story resonated, please like and subscribe for more narratives that explore how money reshapes history. There are more pivot points in history waiting to be heard. And finally, picture Florence at dusk, the Arno laid out like an ink-stained ribbon, the Medici Palace's windows glowing, a ledger closed, and a sermon begun. In that twilight, the old bank's counters are empty, but the family's name still hangs over the city. They had lost a banking empire and gained something else, an institutional immortality built of chapels, crowns, and ducal power. It is a strange kind of survival, not the revival of a business, but the reinvention of a dynasty. The lesson, if there is one, is not moral simplicity, but complexity. When financial instruments fail, human actors find new instruments to play. They write their own rules, and those rules, for better or worse, remake the world.